People are throwing money at random ideas, hoping for one of them to blow up. You have to have a method for this, and spray and pray is not a method. So you've invested in the stock market, and maybe you've tried your luck with crypto, but do you really want to tackle alternative investments in 2025? Well, you've come to the right place. Hi, I'm Johannes, and in this video we'll cover the fundamentals of investing in startups, and I'll give you my personal recommendations on how to get started in this asset class. If you follow this advice, you could be like Peter Thiel, who invested $500,000 in the early days of Facebook, and at the time of the IPO, just 8 years later, sold shares worth over $1 billion. This is a multiple on invested capital of 2,000, so for every dollar he invested, he got $2,000 back. And that's rare, to be honest, but if you follow my advice, it's going to take you one step closer to achieving something like that. Okay, so first of all, let's discuss what even is a startup, or what is a startup in the realm of this video, because we're not talking about investing in a new coffee shop or a restaurant or a traditional business that already exists. When we talk about startups, we are thinking about new and innovative ideas. They're the ideas of tomorrow, essentially, and by the time you read about it in a newspaper, like let's say Uber or Spotify, that's not a startup anymore in terms of how I look at it. This is already an established company, even though they started as a startup at some point. Obviously, there's a spectrum to all this, but try to become an investor in Uber at this point, that's going to be quite difficult. So when we discuss startups here, we're usually talking about a small team looking to solve problems for tomorrow. They usually have an idea and now they need money to build that. Now, this is early stages, of course, but it already shows the fundamental difference between investing into startups and other types of investments, like investing in the stock market or even private equity is a completely different model, because in the startup world, the money goes directly into the companies. It helps the founders grow their business, and you become a shareholder by buying into the company instead of taking someone else's shares. So in the stock market, when you buy shares of Apple, for example, you are buying shares from someone else is selling that, and you're buying those shares. This transaction doesn't have anything to do with the company, and it doesn't help the company in any way. It doesn't make Apple more efficient or helps them develop their ideas more effectively. And the same is true in many private equity transactions. There's an exit happening, and that exit means that old founders or old shareholders are leaving and a new investor comes in and takes ownership over the company. But we're already getting ahead of ourselves here. This transaction with shares, that is something to think about at a later stage. When you're really starting out with investing, you're probably asking yourself, how are you going to get your money back? And here we get to the next fundamental about venture investing, startup investing, is that a lot of times it can happen that you don't get any of your money back, even if the idea is ever so promising. So you need a lot of patience, not just because startups may fail, but also because you have to essentially sit out and wait for a long time. The financing rounds of a startup will go from angel investing to seed rounds. They work their way up as hopefully the valuation increases and the company becomes more and more sophisticated. But it's not until a later liquidity event where the early investors get to get some of their money back. If you're not looking to hold on to the company forever, your option is to wait for an M&A transaction. That can be a strategic buyer, so Google buying your company because you're optimizing some of their processes, for example, or it's a financial buyer and they see it more as an investment. And then, of course, there's the IPO that every founder and early startup investor is looking forward to, because that's a moment when the shares are offered to the public, so you can sell a little bit but not everything, and so you have a liquidity event, but you can still keep some of the shares. Everyone has their own strategy when it comes to that. But the reason why an IPO is so attractive is because the more heat there is around a startup, more liquidity will be in the market. So if at an earlier stage you want to sell your shares, you really have to find the perfect buyer for your shares, and that will be a secondaries transaction. Those are common, but they usually come with a significant discount. So how much money do you need to get started with this startup investing that we're talking about? My recommendation is that you really take your time, because this is not an overnight success project. This is a very long-term project, because over the years you will build up your knowledge and you will become an expert in certain industries, in certain topics, and you will understand more and more what people are talking about when they're pitching you their ideas. Now, you can get started with a few $100s, and that is certainly one way to do it. There are platforms out there that I'll get into at a later stage, but the serious rounds sort of start at 10,000, 25,000 per ticket. That's where it starts. Obviously, there's no limit to it, so to speak, but you really have to stick to your strategy. That means that you should at least have 10,000 to 50,000 per year as a budget with which you can do whatever you want, and it's not going to kill you if you lose all of that, or if you're not going to see it for 10-15 years, because that money is going to be locked up. You're not going to be able to exit it. You really have to understand that. There's a funny thing, because the startup world, like a lot of people want to get into this world, and then they accept all of these things. Yes, I can lose all my money, and yes, there's the possibility for a total wipeout. But then as soon as a company gets into a little bit of trouble, they're like, oh wow, what can we do? This is impossible. And they're panicking. The same people that have said and even signed that they know they could lose it all. Maybe if you can't handle the heat, stay out of the kitchen. It is a special kind of world, and you should definitely pay off all your debt before you get started with this. You should have an emergency fund. You should have enough money so that it's not a complete disaster if it's all lost. And you should probably also have invested some of your money already in other asset classes. Startups is certainly not the first thing you should start investing in. You should already play around with the stock market at least, and then get a feeling for what it's actually like to invest in companies. So my recommendation is that you should have a fixed budget per year if you want to do this, that you will allocate to this asset class. And you have to be quite strict, because you don't want to be carried away with any hype that is inevitably going to come around. Like, we've had so many hypes in new technologies, so you really want to be careful that you're not overly excited as well, because there will be ups and there will be downs, and you should just stay cool. It's a special kind of mentality that you need as a startup investor. But if you invest a certain amount each year into a very specific set of startups that you vet, that you do due diligence on, you really read into the ins and outs of the industry, and you become a little expert on this matter, you're not only going to learn a lot, but you might have a massive upside at the end. So think of it as like going shopping. Like, if you go shopping for a sofa, you're going to instantly lose like 20% of the value. So if you can afford a new sofa, think of it in that sense. Like, then you can afford to lose that money as well in the startups. But the sofa, you have to write it off. The startup may come around and be a massive windfall. But another reason why the spray and pray tactic is wrong, because you actually want to learn something in the process. At least that's my recommendation to you. If you want to invest in a company, you should learn everything about the company, everything about the industry, and therefore, if the money is lost, at least you have this learning, and you know what you could have done better. You're closely involved with everything around that, and you can treat it as a valuable lesson. So how do you find these startup ideas? And this is where the network comes in. Like, you need to network with entrepreneurs. You need to go out there, meet people, and just talk to as many people as you can, because the beauty about startup investing is that personal connection. Just think of the guys on the All In podcast. They share their investments ideas among each other, and by talking about that, they educate themselves, but then they also get information that they otherwise wouldn't get by just reading the newspaper. As we said, by the time you read it in the newspaper, it's already too late. Now, there are, of course, these platforms like AngelList, Seed Invest, WeFunder, Republic, and many others, where retail investors can invest small amounts into innovative ideas. But as we said, first of all, the learning is not there if you just invest with a mouse click, and also the personal connection is what makes venture and startup investing so interesting, because if you meet the founder, you can really engage with them, and you can sense what they need, what they're looking at, and what questions they're asking in the market, and you can really get a better sense if you have that personal connection. Therefore, events in the space, going to conferences or joining professional angel networks, that's all much better in my opinion because you have a personal connection. Now, I already hinted on the alternative approach to startup investing, which in my opinion is the most conservative way to approach this, is to just see and look at everything as a lesson, because that way you're investing in yourself. You're investing into knowledge. You should buy a course that teaches you about business evaluation before you make any venture investment, before you make any investment at all for that matter. That will make you a better investor down the line. So don't rush into it and don't just go with AI because everyone wants to be in AI right now. We don't know where AI will go to, so you have to have a clear understanding. You have to be deep in the space, deep in the research to understand what bets to make and what bets not to make. Every due diligence you do will be a huge learning for you, and you'll learn about the ins and outs of the industry. That learning no one can take away from you. If you want to hear more about different types of investments and be part of a community that shares their knowledge, where we have a future positive mindset, subscribe to this channel.